Morning, everyone. We've had quite a bit of volatility since the start of the year. First of all, precious metals. It looks like those precious metals are recovering along with other mining resource stocks. Then we had considerable volatility in the software sector. We will be looking at that very closely, but of course, this is why we have diversified portfolios, and other sectors have done incredibly well. Also very volatile, but more on the positive side of things. Defense stocks, our defense exposure is up tremendously since the beginning of the year, more or less making up for the losses in HG Capital Trust. We've had incredible volatility with the SpaceX valuation. SpaceX, on a see-through basis, comprises about 2% of our global portfolios and around 1.5% of our balanced portfolios. And SpaceX, in December 2024, SpaceX was valued at 200 billion. It's now 1 trillion. So it's been an incredibly successful investment for our portfolios. We hold it through Edinburgh Worldwide, through Scottish Mortgage, and also through Rothschild Capital Partners. And this really is one of the incredible advantages of our investment strategy, of being able to invest in investment companies, which are closed-end funds. It gives us the opportunity to get exposure to companies like SpaceX and also Anthropic, which is also in our portfolios, which otherwise would not be possible through ETFs or unit trusts. And I just want to read you a little snippet. It illustrates very nicely the advantage of investment companies versus unit trusts. In other words, closed-end funds versus open-end funds. But here is the empirical evidence. With the help of the Association of Investment Companies, and I'm quoting from JP Morgan Cazenove, we have identified 53 investment companies that have a mirror open-ended fund run by the same managers with a similar strategy. The investment company should, in theory, benefit from its closed-end structure, not having to sell to meet redemptions in falling markets, not having to buy when there are cash inflows, and also the ability to gear. There may, in some cases, be lower fees. So what is the empirical evidence? Over 10 years, 44 closed-end funds out of the 53 pairs outperformed in NAV terms. The research that we use, and this is JP Morgan Cazenove. JP Morgan won incredible accolades for their research in 2025, winning all 3 major categories. It's the first time that's been done by any institution. And this is a core research source that we use. And all of this adds up to really good performance. We have beaten the benchmark over all years. If you go all the way back to 2001, we have beaten the benchmark. So over that long time period, we've beaten the benchmark, and we beat it very nicely also in 2025. We're going to be looking at Fed policy, Kevin Warsh's nomination as the next Fed chair. We're then going to move on to other central bank policy and how all that crystallizes or distills into the liquidity discussion. Liquidity drives markets, so it's all important. Finally, we'll be looking at the macro and market views from 2 different research companies, MRB and also the bank credit analyst. So beginning with the Fed policy, at their last meeting on the 28th of January, as expected, the Fed left the policy rate unchanged in a range of 3.5 to 3.75%. They acknowledged that the economy is once again surprised with its strength, and the economic outlook has clearly improved since the last meeting. The forward market has abandoned the expectation of a rate cut under Jerome Powell, pushing out such a move to the June FOMC meeting, by which time Kevin Warsh will have settled in, most likely as the new Fed chairman. Interestingly, on inflation, Powell noted that the Fed saw ongoing disinflation in all the services categories. He also indicated that without tariffs, inflation would only be slightly above the target of 2%. And as a result, the fading of the effect of tariffs later this year signals that the Fed would have more scope to loosen interest rate settings. Jerome Powell alluded to stronger productivity growth, which would in principle raise the economy's potential growth rates and in the process put a lid on inflation. So finally, President Trump has made his decision. We've been waiting for a long time for who he would nominate as the next Fed chairman. Of course, Congress needs to approve that nomination, but it seems likely that Congress will do. And I think the nomination of Kevin Warsh reduces a key source of uncertainty around US economic policy. The perception seems to be that he is someone who is well qualified for the job. He's unlikely to undermine the Fed's independence, and he's unlikely to be firmly in the president's pocket. He has expressed support for lower interest rates, but unlike the other main candidates for the Fed chairmanship, he has also suggested that this could come at the expense of shrinking the central bank's balance sheet. And that has slightly unsettled financial markets. In practice, though, it would be very difficult to implement a significant reduction in the Fed's balance sheet. And then moving on now to other central banks, big news on the 3rd of February, the Reserve Bank of Australia became the first G10 central bank in the current cycle to return to a hiking of interest rates. So it's been expected for some time, and indeed, Australian government bonds have been punished of late. We spoke last month that the Reserve Bank of Australia and the Reserve Bank of New Zealand, which is now expected to hike twice by the end of 2026, tend to lead the interest rate cycle, and they could indeed be the canaries in the coal mine as far as interest rates are concerned and bond yields. In fact, investors seem to see a chance of hikes almost everywhere by the end of 2027. And what does all this mean for global liquidity? Cross-border capital has changed its name. It's now Global Liquidity Indexes, but it's still managed by Michael Howell. He sees a distinct slowdown in liquidity growth, which is not bullish for risk assets. Even though the US liquidity index is leading the down cycle, China stands at the other extreme. There's been easing by the People's Bank of China, and the Chinese liquidity cycle is in a clear upswing. 2026 could pose significant headwinds for financial markets and risk assets, despite a likely strengthening world real economy. The key driver will be a tightening of global liquidity. But it is not evidenced by China, which appears to be in a very different cycle. The degree of desynchronization between the US and China now stands at extreme levels. Luckily, we do have quite a bit of exposure to China, and maybe we'll get even more. Since mid-2023, China has suffered a tightening liquidity cycle that only now appears to be bottoming out. And it's interesting, this report looks at the different phases in the asset allocation cycle for the different regions of the world. So the time to be nibbling away in the markets is at the rebound phase, and that moves to the equities bull market, the risk-on phase, and then we get the market still rising during the calm and still rising a little bit during the speculation phase. But by the time you get to speculation and turbulence, it's back to risk off. So risk on is rebound and calm, and risk off is speculation and turbulence. So interesting, where are we? The US market is currently positioned in speculation. Europe and Asia, excluding China, are in late calm, and China is in rebound. So the projected US global liquidity trough in late 2027 and the current Chinese low are key future inflection points that trigger asset reallocation. So according to that textbook, you may very well expect a rotation from US into China. And now let's look at the macro and market views from different institutions, beginning with NRB. They haven't really changed their tune much. They've obviously got a very firm conviction. Quote, the very long end of developed market yield curves suggests a growing unease with inflation and fiscal policies. We remain vigilant, yet still optimistic that the Goldilocks backdrop will persist for a while yet. Despite standing pat in the last interest rate policy meeting, the Fed's FOMC still has a dovish bias and has indicated that it plans to lower the policy rate to its estimate of the long-run equilibrium rate. In other words, a cut of another 50 basis points from 3.5% to 3%. As long as the FOMC stays dovish and bond investors take their cues exclusively from the Fed, the longer the economic expansion and asset price inflation will persist. And that does seem likely if Kevin Warsh ends up being the new Fed chairman, which seems extremely likely. Adding it all up, it seems likely that the economic and asset price inflation party will persist until developed market government bond yields rise too far. US Treasury yields need monitoring as they remain the most heavily followed global debt instrument. And then we move on finally to bank credit analyst. On inflation, they have a benign inflation outlook. The Fed has a basis to claim that sticky inflation simply reflects the impact of US import tariffs on goods prices. Sticky core inflation simply reflects the combined effect of still falling housing inflation from high levels and a pickup in tariffed core goods prices. In other words, they believe in transitory inflation. Outside of the US, inflation does not appear to be a major threat. Headline and core inflation are below 3% in the G7, excluding the US, and closer to 2% in the Euro area. And in China, inflation is low. Our base case view is that global inflation will continue to shift lower in 2026, and that a hawkish monetary policy surprise is not on the cards. Moving to the Eurozone, the return of inflation to the ECB's target has enabled the central bank to cut policy rates. Both credit growth and economic activity have since stabilized. Importantly, credit flows to the non-financial corporate sector have improved, and household finances are in good shape. Fiscal policy has turned modestly expansionary, led by Germany's €1 trillion infrastructure and defense initiative, marking the end of a decade of austerity. Moving to China, Beijing's newly released 15th five-year plan reiterates the goal of increasing the household consumption share in the economy meaningfully, which on the surface is a positive sign. With housing comprising roughly 60% of household assets, property market swings the dominant driver of household wealth effects, household sentiments, and consumer expenditure. And then finally, a replay of the late 1990s episode implies another 25 to 30% upside for US stocks in an AI melt-up scenario, with the stock market likely peaking in late 2026 or sometime in 2027. And of course, we know that the S&P 500 only peaked in February 2000. If equity risk premium-based valuation approaches are used, it implies even more upside, and that's because real interest rates are much lower now than they were then. And the real interest rate is the yield on the Treasury inflation-protected security, the 10-year TIPS yield. So on that happy note, we conclude the global section of the report.
Thank you for that, Nick. Definitely a lot going on the global side, but I think our portfolios are built to weather the storm. So for the local side, firstly, we'll start by reviewing past month on the JSE, as well as what's expected going forward. Second up, we'll have a look at some macro data points and how we expect those to impact our portfolios, as well as asset allocation within the OAM models. We'll touch on things like the interest rate decision that happened last week, as well as PPI for December 2025 and one or two other data points. And then thirdly, I'll move on to some recent updates from our local holdings that are in model portfolios, as well as touch on one or two changes that we've recently implemented in our models. So starting off with the JSE, I'm sure you've all noticed 2026 has kicked off with quite a bang. As of yesterday, the JSE ALSI is up 2.7% year to date, and the capped SWIX ALSI 5% year to date so far. As we saw last year, majority of those gains were concentrated in the resource space, with the J210 index up 11% year to date, even after that 10% drop we saw on Friday last week. So that can be seen by looking at the pink line on this line graph. So it does kind of make sense that investors were looking to take profits here. If we move over to the financial 15, that's also continued where it left off last year, already boasting 5.5% return so far this year. That's the green line that you can see on the chart, going in that upward trajectory. The quality of SA financial institutions is often highlighted by industry professionals, and one need only look at the total returns over the past 5 years to confirm that. We have confidence here, but more on that in the next section. So moving on to some local macro data points. We did see quite a bit of data that came out over the past month. So I'll just start with the most recent, which was the Reserve Bank rate decision. The SARB had their first meeting of the year last week, and as usual, that took place on a Thursday at 3 o'clock. Much like the Fed, Kenyago and the rest of the MPC did decide to keep rates on hold, and that leaves the repo rate at 6.75% and prime at 10.5%. So just to give some more context around that, in terms of the vote split, 2 MPC members were in fact aiming for a cut, but the other 4 voted to keep the rate on hold. And although investors would have wanted a cut, it is in line with expectations for the first meeting of the year. However, let's not ignore the elephant in the room and what happened with inflation last year. Yes, December print came in slightly higher, 3.6% versus the 3.5% seen in November. This was most likely the handbrake for not putting a rate cut through in this meeting, but it did leave the annual inflation rate over the year at 3.2%. So not only is that the lowest we've seen in 21 years, but inflation remains well within the target band. The new target was set at 3%, with a 1% tolerance band both above and below, effectively making the target range 2 to 4%. With inflation under control, we remain very confident in a further 50 basis point cut throughout the year. Some analysts have even suggested a 75 basis point, but I'm going to be more conservative with that one. Moving on to the PPI stat that came out for December. We saw that factory gate prices increased 0.2% month on month and 2.9% year on year in December last year, with the main contributors being food products, beverages, and tobacco, which increased 2.9% year on year. On average, though, PPI inflation over the past 3 years is seeing downward trajectory. Last year it was at 1.5%, the year prior it was 3.1%, and in 2023 it was all the way up at 6.7%. Given that PPI is a leading indicator of CPI, or consumer inflation, that's a major positive. Lower cost pressures on companies decreases their need to pass on those additional costs to their consumers, and therefore helps retain their margins, ultimately increasing profitability. Then just some final data points that came out for November. Mining output fell slightly, 2.7% year on year, which did in fact go against expectations, which were for another increase. We saw output falling in 6 of the 12 categories, with most miners seeing a decrease in output. Retail sales growth was more positive though, rising by 3.5% year on year, with largest contributors there being the general dealers, other retailers, and pharmaceuticals. And then we also saw some positive news when it came to vehicle numbers, with new vehicle sales increasing just shy of 6.5%. So consumers do seem to be replacing vehicles rather than fixing them, which should bode well for a company like We Buy Cars. The question on everyone's minds: what does this all mean? As Vadner pointed out in last month's update, we are seeing more positive than negative when it comes to the local environment. SA looks to be moving in an upward direction. Lower interest rates make it easier for households and businesses to borrow and invest. Lower inflation puts spending power back into the consumer's pocket, giving them the ability to enjoy more goods and services. Eskom's energy availability factor is in a strong position, sitting 15% points higher than where it was this time last year. And the SARB composite business leading indicator continues to increase. Ultimately, this all leads to a more active economy, lifting GDP at the end of the day. The industries that should benefit directly from this high activity should be retail, banks, and construction, all of which we have significant exposure to. Moving on to some recent updates from our portfolio companies. Let's kick it off with Valterra. Results are expected to be released on the 25th of Feb this year. Headline earnings have seen a major boost thanks to a stellar second half last year, with an expected increase between 85 and 105% compared to 2024. Just to put that in perspective, that's 15 to 17 billion rand in earnings for last year. The attractive figure is mostly thanks to the rally that we've seen in PGM prices so far, but there have also been some operational wins at Valterra. Next up, we have Pepkor. They also released a trading statement recently, and we see that the retail giant, giving the update for the 3 months ending December 2025, continues to soldier on. Fintech is shining, with revenue up more than 25%. Financial services have followed suit, with their revenue rising almost 48%. And retail sales, although slightly more modest growth that we're seeing there, they still have like-for-like sales growth of 3%. So I think something important to note here is that the credit, insurance, and digital services were set up at Pepkor originally as sales enablers, not necessarily as main revenue sources for the company, but the numbers seem to be telling us a different story. People are definitely loving what the company is offering. If we just look at their phone rental product, Phoniam, that grew its customer base almost 100% over the past year. That's got now 2.3 million active users. Looking at their app, the Plus More app, which hosts the loyalty program for Pepkor, also has more than 13 million members at the moment. So yes, Pepkor still dominates the baby space, children's clothing, and mobile phone sales. But they're also en route to becoming a data-driven retailer that provides the best possible experience for shoppers, both in-store as well as online. Finally, I think I'll just touch on some changes we've recently implemented in the local portfolios. So 2 weeks ago, in the investment committee, we decided to buy Raubex reduce US and UK exposure, and also buy a resource ETF. From a macro standpoint, we see a potential recovery in SA cyclicals. Inflation is at multi-decade lows, rate cuts are expected, and business confidence is turning. Gross fixed capital formation is expected to recover if the turnaround is sustained, and both infrastructure and construction companies are likely beneficiaries of the improved fiscal discipline and private sector capex spend. We already know Raubex as a company. They have a strong balance sheet and order book, and are also a strategic fit with our existing exposure to Afrimat. We've allocated 4% to the growth portfolio and 3% to balanced. At the same time, US exposure was rebalanced to target and UK exposure was reduced to fund our higher conviction domestic ideas, also to manage our currency risk. A structurally weaker USD and strengthening Rand, supported by higher commodity prices as well as SA fundamentals, reduces the potential return from offshore equity exposure when measured in Rand terms. Capital was reallocated into that Resi ETF to increase exposure to resources and commodities, which historically perform well in periods of USD weakness and rising real asset demand. The Resi ETF provides diversified exposure to gold, platinum, and broader mining shares, allowing the portfolios to participate in the ongoing commodity upcycle while reducing company-specific risk. However, Nick, as you mentioned, given the volatility in the space, we've opted to go with caution here. We remain underweight versus the benchmark. As usual, we'll continue to keep our finger on the pulse with the local portfolios, constantly search for new opportunities. That's all from the local team today.